Wall Street is throwing a party for Morgan Stanley after its incredible Q3 earnings report. But I'm not popping any champagne. In fact, I think the bank is staring down a hidden danger in 2025 that most investors are completely ignoring. Today, I'm breaking down the 3 critical risks that could derail the stock next year. On the surface, everything looks perfect. Morgan Stanley just delivered one of its best quarters in recent memory. The firm reported stunning net revenues of $18.22 billion and a net income of $4.6 billion. That works out to earnings of $2.80 per share, which absolutely crushed analyst estimates that were hovering closer to $2.10. Every part of the business seems to be firing on all cylinders. A boom in M&A activity sent investment banking fees surging by 44%. Wealth management pulled in a record $8.23 billion in revenue and attracted another $81 billion in net new client assets. But the real showstopper was the trading division. Equity trading revenue soared 35% to over $4.1 billion, a figure so strong it leapfrogged its arch-rival Goldman Sachs. As you'd expect, investors were ecstatic. The stock jumped on the news and is now up around 26% for the year, easily outpacing the broader market. The story is clear. Morgan Stanley is a brilliantly run bank with a flawless strategy. And if you just read the headlines, you'd think the good times are here to stay. But there's another side to this story that most people are missing. When you look under the hood, past those incredible quarterly numbers, you'll see significant risks for 2025 that challenge this rosy picture. And today, we're going to break down the 3 biggest dangers I see on the horizon. The first danger, euphoria and extreme valuations. The first hidden danger is the very thing that feels so good right now, market euphoria. Both the broader market and Morgan Stanley stock have had a phenomenal run. The stock recently touched an all-time high, and its year-to-date gain is nearly double that of the S&P 500. This is where the first red flag pops up. When a stock outperforms this dramatically, it's often priced for perfection. Any small misstep can lead to a sharp correction. Right now, the market is overwhelmingly optimistic, but this level of optimism often signals complacency. As Patrick Farrell, the chief investment officer at Charles Stanley, recently warned, market volatility will be high and susceptibility to downside risks will be elevated should companies make any misstep. This is especially true for market leaders, and while Morgan Stanley isn't a tech stock, its fortunes are deeply tied to the market's overall health. A huge portion of its record-breaking earnings comes from trading and investment banking, 2 areas that thrive in a bull market but can dry up in a heartbeat when sentiment turns. The problem is the current stock price seems to be baking in a perfect 2025, a strong economy, booming markets, and a surge in deal-making. But what if that doesn't happen? Many analysts are already signaling caution. The average 12-month price target from several analysts for Morgan Stanley is actually slightly below its current price, suggesting Wall Street itself believes the stock may have gotten ahead of itself. While some analysts have targets as high as $180, others see it falling to $122, highlighting a huge range of opinions and underlying uncertainty. This gets to the heart of the first risk. The market is celebrating lagging indicators. The Q3 earnings report is a snapshot of the last 3 months, but the stock market is a forward-looking machine, and when we look ahead, the picture gets much cloudier. The market's euphoric state has created a valuation that leaves very little room for error at a time when the potential for error is rising. That leads directly to our second major risk. The second hidden danger is the escalating geopolitical tension between the United States and China. This might seem like a distant political issue, but for a global bank like Morgan Stanley, it's a direct threat to the bottom line. In just the past few weeks, we've seen a rapid escalation, with the U.S. imposing new tariffs and China retaliating with new port fees on U.S. ships and launching investigations into American companies. This isn't just political posturing, it has real-world consequences that could unravel the foundation of Morgan Stanley's recent success. Think about their booming investment banking division, which just saw fees jump 44%. A huge portion of that business relies on cross-border M&A, capital flows, and global supply chains. A trade war grinds all of that to a halt. Companies get hesitant to make major international deals when facing regulatory uncertainty and tariff threats. That blockbuster M&A pipeline that fueled Q3 could dry up in a matter of months. The impact also extends to its wealth management arm. With nearly $8.9